A mortgage allows a homeowner to trade in their existing loan for a new one with better terms, like a lower principal, interest rate, or monthly payment. But there is a cost to refinancing. Here to break down what homeowners can expect to pay, Yahoo Finance personal finance editor Laura Grace Tarpley. So Laura Grace, what are some of the closing costs that people have to be aware of with refinancing?
Hi, Julie. Yeah, so like you just said, when you refinance your mortgage, what you're actually doing is replacing your original mortgage with a new one, which means that you do have to pay closing costs again. Refinance closing costs typically come to about 2 to 6% of the loan amount, which means if you're taking out a $400,000 loan, you can expect to pay roughly $8,000 to $24,000 in closing costs. And those can cover a variety of things from your application fee to a home appraisal, because when you refinance, you do have to get a home appraisal again to get the updated value of your home. Also, because you're taking out a new mortgage, you do have to open a new escrow account. And this is the account where you keep money for things like your homeowner's insurance and your property taxes. Depending on your lender, they may require you to put 1 to 2 months of homeowners insurance and property tax money into this new escrow account, along with what you're moving over from your old one. So that's an expense you should be prepared for.
And what are some of the factors that affect that cost of refinancing?
Yeah, the most obvious one is probably the loan amount, how much you're borrowing. For example, if the lender charges a 1% origination fee, 1% of $500,000 is going to be more than 1% of $400,000. Another one is location. Your local government can play a part in what you pay in closing costs. For example, property taxes vary depending on where you live. You'll also pay recording fees, which is the fee that covers putting your loan details and documents into the public record, and that varies depending on your state or local government. Another one is your credit score, and I'll get into this a little bit more, but generally, like the higher your credit score or the better your overall finances, the better terms a lender may offer you. Another one is your home equity. If you refinance into a conventional loan and you don't have 20% equity in your home, you will have to pay for private mortgage insurance, which you could pay for at closing, you could pay for it monthly. And then if you are refinancing and you have more than 20% of home equity, then you don't have to worry about that cost. Finally, the lender and something called mortgage lender fees. There are some closing costs that are just inevitable, such as a home appraisal. You're going to have that done. But there are also ones called mortgage lender fees that is money that goes to the lender, like the application fee, the underwriting or origination fee. And every lender charges different fees for this. So one might charge a lower origination fee than another. One might just not charge an application fee at all. So the lender you choose will also play a role in how much you pay in closing costs.
And do you have any control over these costs? Are there any ways to lower them?
Yeah, absolutely. There are certain things that you can do. Going back to that credit score, you can work on improving that by making sure you're making all of your bill payments on time and paying down debt, because once again, the stronger your financial profile, the better terms a lender tends to offer you. You should also compare mortgage refinance rates among different lenders. So you can refinance with the same lender you used for your original mortgage, but you don't have to. So it's good to compare 3 or 4 different companies to see which ones offer the lowest refinance rates, which ones offer the lowest mortgage lender fees, and see which will offer you the best combination of those. Another one is that you can negotiate on closing costs, especially if you have a high credit score and good income or good debt to income ratio. This makes you like a prime candidate for a loan from a mortgage lender, and that can give you more bargaining power. So you might ask, hey, can you waive the application for me, or can you lower this other mortgage lender fee for me? And it might give you more legwork there. And finally, you can consider a no closing cost refinance. There is a type of refinance where you don't have to pay closing costs, but there is a catch. So you don't pay the closing costs up front, but you add it to your loan. It gets rolled into your mortgage balance.